Hi everyone, it's David Pryor again from Priority Funding and Forward Funding, and we're looking at further frequently asked questions to help businesses with finance. So the next one we're talking about is in the context of a secured loan, how much can I borrow against an asset, and how much is that asset valued at? Okay, so this logic is if it's a private sale and you have a truck or a vehicle or any equipment that we can finance against for your business. You might use that for paying off debt or securing a contract or anything like that, or securing other equipment. But what happens when we're using a private sale is that we actually have that equipment valued by a traditional valuer, okay? And let's use a truck. We might do online version of the truck. It might be worth $100,000, okay? And what we do is a valuer will then view that to see if it is actually worth that $100,000. Okay, they might do a liquidated sale, they might do an auction sale value, depending on which lender, what protocol they use. But essentially, they're looking at if they have to take that equipment back to sell if you don't pay, then how much can they make back against that equipment? How much security do they have against that equipment? So the next step is, does the lender lend 100% of the value it's perceived at, or do they lend a percentage of that value? And that comes down to the policies of the particular lender, the rates, the type of asset, the need. Are we paying off tax debt? Are we in real trouble within the business? Do we need to go to a fourth or fifth tier lender? The fourth or fifth tier lenders tend to lend about 70% of the value of that equipment, of that private sale, because they want to minimize their risk, okay? But they'll look at people who are more in trouble in business, whereas your better lenders will actually end up to 100% of that value. You can then fund that over a 2, 3, 4, 5 year period, and effectively your payments will be set for that term. Okay, so yes, you can do that. You cannot borrow more than the value of that equipment, because then that lender is not actually securing against the lender they're providing to you. Okay. Next question. What are the implications for the remaining debt if the collateral is liquidated for an amount lower than the loan value? So you've got yourself into trouble, and we need to sell the equipment, or the lender needs to sell the equipment, and the finance contract might owe $50,000, and they sell the equipment for $35,000 for whatever reason, whether it's liquidated, whether it's auction, whatever it may be. There's a balance of $15,000 left. So with that $15,000, generally the lender will come back to the client and say, okay, Mr. or Mrs. Customer, how are we going to pay the balance of this back? Now, if you go bankrupt, if you can't make a payment, that's not good, because that, for the lender, they lose out. So they're going to try and negotiate with you as best practices. Okay, so if you say I'm going to give you 1 cent a month, then that's never going to work. Whereas if you come up with a payment plan and keep that payment plan, you will keep yourself from that bankruptcy or whatever it may be. So they're the sort of things: negotiate, communicate, find a way to work with the lender, okay? The lender does not want to write the debt off, because it's bad for their books. The lender wants to work with you to try and find the best appropriate solution. That'll do for today. It's a short one today, but we'll get on to another one tomorrow on advantages of line of credits and set and forget unsecured loans. Thank you.